So I think that the money flow is moving. And I think the silver situation is very unique because there's a mistake being made. One, it does move with gold ultimately. It does not move with commodities generally. Their historical correlation is not good. Its correlation with gold is very good. Right now it's in a slingshot underperformance situation to gold, but I think it's a great mistake which will snap back quickly. So when gold does start to outperform, my bet is it doesn't crawl back. It does something fairly explosive in terms of net price gain.
In today's news recap, silver hits over 8-week low as market frets about industrial demand. Prices of silver dropped to over 8-week lows on Friday as concerns about demand for the industrial precious metal dominated sentiment due to recession fears stemming from U.S. President Donald Trump's slew of tariffs. Silver typically tends to move alongside gold, but industrial uses such as electronics and photovoltaics account for more than half of global demand, estimated at around 700.2 million troy ounces as of 2024, according to the Silver Institute Industry Association. While gold, traditionally seen as a refuge from political and economic uncertainty, has touched multiple record highs this year, silver has struggled to break through the 12-year peak at $34.87 an ounce. It hit on October 22nd, 2024 at $31 an ounce. Silver has dropped nearly 9% since Trump's latest tariffs announcements on Wednesday. I would expect silver to lag gold until there is more economic clarity and a resolution in trade and tariff risks, given silver's exposure to industrial activity and PMIs, said Akash Doshi, global head of gold strategy at State Street Global Advisors. Trump's tariffs, robust central bank buying, increased flows into gold-backed exchange, traded funds, and worries about inflationary pressures have fueled safe haven gold's surge in 2025. Spot prices hit a record high of $3,167.57 on Thursday. But the gold-silver ratio, a measure of the amounts of silver needed to buy 1 ounce of gold, is currently at 100, its highest level since June 2020. The upside provided by heightened safe haven demand will be capped by silver's negative industrial angle, said Ricardo Evangelista, senior analyst at brokerage firm Active Trades. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Well, if you look at the mama market, gold, right now as we speak, it's trading 3.5%, okay, off of its high daily close, which occurred a week ago. But it's down 3.5%. Okay. Stock market was, look at, bank sector, stock market, and silver and commodities also going down because, we're going into a depression or something. Well, we might be, frankly. But there's a couple mistakes there. One is the assumption gold goes down with the stock market. Yeah, it could go down on a couple weeks here and there with the stock market in a sharp situation. But let's go back and look, for example, at that October of 2008 event. That's when the stock market had already been coming down hard for a full year and finally had a puke. Okay, and gold said, I need to correct anyway, so it had a puke. The Fed sat and watched the banking sector implode during the summer. The Lehman Brothers went under in September of 2008. Stock market collapsed the next month in October. And it wasn't until November that the Fed finally said, okay, we got to do something. They'd been cutting rates all the way down, but they did QE at that point. So right after that October collapse, a full month or two after Lehman went under, the Fed finally woke up, copied the Japanese model, and started doing QEs. November 2008. Stock market, by the way, went down for 5 more months. into March of 2009, substantially further lower. But if you bought early in November, right after that October debacle, where you thought, oh, stock's going down, therefore gold goes down, actually, gold stopped and turned and started to explode back to its highs within about 3 or 4 months, had gained from the 600s back to 1,000, like a 50% gain. Not because the stock market turned up, no, because the Fed hit the pedal. And that's what causes gold to move the way it does. Now, right now, if you look at Powell today, they're not going to hit the pedal. He's just going to be academic about it and wait for the data points. I mean, when the blood's in the street, he'll finally see the data points. I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market. So everybody's talking about, oh, well, Tesla collapsed and Nvidia's down hard. Who cares? It's the banks that matter to the Fed. After all, the Fed is the banks, okay? Now, that's why gold's down 3.5%. Somebody's buying gold relative to the rest of the world. And I think that's because they see what's coming. The Fed has maybe learned a lesson since 2008 and learned, hey, we can't wait too long. We can't wait for an actual big bank to go under because then we'll look like idiots. We need to actually do a QE, start buying assets, start buying banking ETFs or whatever, bank stocks or commercial real estate's another implosion area, before it becomes a bloody headline. And I think gold knows that. It knows maybe the Fed's a little smarter now and will implement their aggressive policies real soon. Watch the bank sector. That's the key. Now, the case is silver. Investors are making a big mistake there. Okay, if we're going into a major global recession, maybe a depression, wouldn't surprise me, given the bubble size of the U.S. stock market, the Japanese market, and the Indian market. They're all imploding together. Industrial commodities will go down. Now, they don't necessarily have to stay down because when the Fed puts the pedal to the floor again, that money goes somewhere and commodities are still dirt cheap and we think they're going to go up. But right now they're going down with the stock market. Industrial commodities, crude oil, copper. Okay, they're treating silver not like gold. Like I said, down 3%. Silver's dropped from $35 to $29 almost in a matter of a week or so. It's behaving like copper and oil. Somebody's making the conceptual error that silver's an industrial commodity, not a monetary metal. So just fundamentally, now there's technical reasons for what I'm saying. Just fundamentally, if I were an investor wanting to put my money in monetary metals, knowing that the Fed's going to panic here, probably sooner than they did in 2008, that I want to own monetary metals because paper money is going to be far worth less than it might otherwise be because they'll accelerate the growth in the money supply. I'd look around and I'd say, well, gold's behaving well. Yeah, I'd want to be in gold, but that silver's ridiculous. It's a slingshot situation. It is not copper. It is not crude oil. Okay? It's a monetary metal. And right now, for the last week, investors have forgotten that. And they often make mistakes. Investment crowd often makes excessive mistakes either way. So right now, I'd say we see this pullback in gold and silver as a major buying opportunity. We're looking for the least excuse to define the upturn. And I strongly suspect it won't really take a full 30% crash in the stock market to do that. I think you got to watch the banking sector. If it doesn't behave well real soon, and already it's done so much damage, I don't think it will, the Fed will panic. And that's the name of the game.
In today's news recap, silver tumbles on trade war, demand concerns. Silver fell to $31 per ounce on Friday, the lowest level since January 29th, bringing weekly losses to over 9% as the escalating trade war fueled concerns over global demand and recession risks. China's finance ministry announced on Friday that it would impose a 34% tariff on all U.S. goods starting April 10th, retaliating against the duties imposed by the Trump administration earlier this week. Trump had announced on Wednesday a 10% baseline tariff on all imports, with higher rates targeting major economies, including China 54%, the EU 20%, Japan 24%, and India 27%. Trump even taxed melee with a 10% tariff on Argentina. Equities and commodities took the hardest hit in the sell-off, while investors flocked to safe haven assets like government bonds. Despite the broader market slump, silver and other precious metals may receive renewed support as recession fears intensify, with traders increasingly pricing in potential Federal Reserve rate cuts in the months ahead. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
To break out, as has the gold miners versus gold. Which, when you plot the spread chart, and we do it like weekly in our reports, there's certain levels. If you can get GDX up to a certain level versus gold, it's going to break up a couple year downtrend on the spread and say, okay, I'm back. Okay. Silver has a similar situation, and you're right, we're literally in the gutter historically in terms of price. So either we're totally wrong and silver is no longer a monetary metal, which I don't think is the case. And by the way, if you go back, for example, over the last year, for let's say March of 2024 to the close of last month, silver went up, the commodity index went up a slight amount, I think, during that year, a couple percent. Silver went up almost as much as gold on a percentage basis over that 12-month period. So silver was moving with the monetary metal, not with crude oil, which is laying, on the floor for the last year, or copper. It was behaving like gold. And suddenly for this week, it's not behaving like gold. I think that's a mistake. Silver is the little puppy on a leash held by gold, okay? And I think right now it is in a slingshot position. Yes, there may be slightly lower lows next week, but I'd be watching right now for any sign of an upturn. There's another reason, technically. I used to keep point and figure charts, people, the X's and O's, where you get upticks, you get downticks. Silver never tops with a double top. Well, we made a high at 35 back in October. We had a drop down to 30. So you had 4 downticks on a $1 chart. Then you went back up to what? 35 last month and this month. You put the upticks back on the board to 35. So you peaked at the same level you did last October. And now you've downticked again to 30. Almost traded 29 today. I actually want to see it trade to 29 and take out that last low. So people then pull their hair out. So, oh my gosh, it's no good. Because on a point and figure, when you do that, you set up a double top and take out the column low. Pardon me if I'm being academic here. And then you start to uptick. What it was a bear trap low, meaning you went down and took out the last low to spook people. And if you don't sustain and you start to uptick, you're headed for a triple top breakout. And I think that's what silver's setting up here, is a compression situation where it flushes everybody out without the help of gold. Like gold's only dropped 3.5% and suddenly turns and burns. And so I think watch gold. I don't think it's going to do what the stock market's doing or what silver's already done or what commodities have done. It's hanging in there pretty tough. And I think that says something. And I would focus on the banks because we know that that's the arena that will cause the Fed to, not openly and publicly, but to quietly, behind the scenes, panic. And probably even have a cut or QE instituted even before the next meeting. It could be, obviously, it could be 1 or 2 or 3 here or there, but I'm just looking at all of them, and they're all behaving very much the same. The only difference is some of them are down a little more than the others. Bank of America and Citicorp have dropped more than, let's say, JP Morgan or a few others, but they're all down hard. And the point is, it's not that they've been going down for a long time and are therefore might be near the end of a decline. By our metrics, the decline just commenced. Technically speaking, on quarterly momentum. It just broke late last month, early this month. So the game is just on. and they have a long way to go, and they're doing a lot of damage. And I can see some of the price charts that people are looking at saying, well, let's try to buy it here. It's ripping through prior pivotal lows freshly. So even the price guys should start to get concerned here. But I think that's the area that, again, it's not a headline. For some reason, they're still focused on the Mag 7. But it's the banks that are the one that really count. And the other sector that is very dangerous is commercial real estate. We've been pounding the table about that for quite a while. Not mortgage real estate, but commercial real estate, because that's a debt crisis arena. And there's a couple of ETFs on that, RWR and VNQ, that you can look at. And they own the big companies that own the shopping centers and the commercial centers and the computer centers and all kinds of things like that, that look like hell, technically. And they have a lot of debt. And we know that that could be an arena that impacts the banks if you start to have problems there. And so don't be surprised in the next month or so, you start to see some, oh my gosh, a headline out of the financial arena. And that's when the panic really sets, because when the public starts to hear that stuff, NVIDIA going down is one thing, but when you start to have banking problems, the Fed will panic and will public. So I think we're near that point. So what I'm looking for is the stock market drop to actually explode gold, especially the banking sector, because that's when the Fed puts the pedal to the floor, and we're back in November of 2008. Forget the October drop. It's the November action by the Fed that took gold right off the page and went from 600 and something up to over almost 2,000 over the next couple of years. Despite the stock market continuing down for 2 more quarters, gold was back to its highs. So I think we're in that kind of situation right now.
What do you think of Michael's take? Do you agree with his call that a breakout in precious metals is not just likely, but inevitable? Is the S&P living on borrowed time? Let me know what you think in the comments below. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.